They waited until the markets closed. It's an old pattern, a predictable one, but effective nonetheless. Last Friday, while Wall Street was calculating weekend positions and most analysts were reviewing quarterly reports, something shifted in the architecture of American debt that changes the fundamental mathematics of fiscal sustainability. If you looked at the headlines this morning, you saw the usual theater: politicians debating spending priorities, economists arguing over inflation targets, credit agencies issuing measured warnings about long-term sustainability. But they are missing the most critical detail, the detail that transforms $38 trillion from an accounting problem into a structural crisis, the detail that makes traditional debt analysis look like a rounding error. This discussion is for educational and analytical purposes only and does not constitute financial advice. The secret isn't in the total amount. Every economist can see $38 trillion. The secret lies in how that debt is being quietly redefined through mechanisms that most people don't understand and most media outlets don't cover. We've crossed a threshold. This isn't gradual deterioration anymore. This is a phased transition into a new regime where the old rules of debt management no longer apply. In this comprehensive investigation, I'm going to expose the hidden architecture that's transforming American debt from a manageable obligation into a self-reinforcing trap. I'm going to walk you through the legislative alchemy that turns $5 trillion spending bills into routine policy extensions. I'm going to show you the mathematical certainty that interest payments alone will consume more federal revenue than entire government departments, and I'm going to demonstrate why the recent passage of the One Big Beautiful Bill Act wasn't just another spending measure. It was the moment when fiscal policy crossed into uncharted territory. The media is calling it routine governance. They're talking about necessary infrastructure investments and tax policy adjustments, but they're missing the single most important transformation. The transformation that Wall Street hasn't fully priced in. The transformation that makes historical debt comparisons meaningless. America isn't just borrowing more money. It's fundamentally redefining what debt means and how it functions within the economic system. To understand why $38 trillion represents a structural break from everything that came before, you have to understand the machinery that created it. Most people think government debt works like household debt. You borrow money, you pay it back with interest, and eventually the balance goes to zero. That model stopped applying to federal debt decades ago. What we have now is something entirely different. It's a self-perpetuating system where debt creates the conditions for more debt, and the mechanisms designed to control it have become the mechanisms that accelerate it. The transformation began with a piece of legislation that most Americans never heard of. The One Big Beautiful Bill Act, passed on July 4, 2025, raised the debt ceiling by $5 trillion. That's the largest specified debt limit increase in American history. The previous record was $2.5 trillion. But the mechanics of how this happened reveal something far more significant than the dollar amount suggests. This wasn't emergency legislation. It wasn't a response to a crisis or an unexpected economic shock. It was budget reconciliation, packaged as routine policy extension. The bill contains $7.7 trillion in tax cuts offset by $3.9 trillion in revenue measures, creating a net cost of $3.8 trillion over 10 years. But here's where the alchemy becomes apparent. If the temporary provisions become permanent, which historical analysis suggests they will, the actual 10-year cost rises to $5.3 trillion. The Committee for a Responsible Federal Budget estimates that policymakers added $4.1 trillion in new 10-year debt in 2025 alone. Most of that came from this single piece of legislation. That represents the largest annual addition to projected debt since 2022. But the bill's structure makes the true fiscal impact nearly invisible to standard budget analysis. The legislation exploits what budget experts call baseline assumptions. When temporary tax cuts expire under current law, the baseline assumes they stay expired. When new temporary tax cuts are created, the baseline only counts their explicit duration. This creates an accounting framework where a $7.7 trillion spending commitment appears as a $3.8 trillion cost, and a $5.3 trillion long-term obligation looks like responsible fiscal management. This is fiscal engineering on a scale that transforms the relationship between policy and debt. Previous debt expansions, even during wartime or economic crisis, operated within existing frameworks. They increased spending or cut taxes within established categories. The One Big Beautiful Bill Act represents something different. It's the institutionalization of debt expansion as a routine governance mechanism. Consider the mathematics of what just happened. The United States added $4.1 trillion to its projected debt in a single year through legislative action. That's equivalent to adding the entire GDP of Germany to America's debt burden through the stroke of a pen. The Congressional Budget Office now projects that federal debt as a share of GDP will reach 126% by 2034, compared to their January 2025 baseline projection of 117%. But the real transformation isn't in the total debt. It's in how that debt functions within the broader economic system. The composition of debt holders has undergone a fundamental shift that changes the entire dynamic of how America finances its operations. Foreign governments, which accounted for more than 40% of Treasury holdings in the early 2000s, have not increased their purchases in line with the recent surge in debt issuance. Private investors have stepped into that gap, but they operate under completely different incentives than foreign central banks. Hedge funds have doubled their presence in the Treasury market over the last 4 years. The biggest share of U.S. debt held outside the country is now in the Cayman Islands, where many hedge funds are officially based. These are profit-driven entities that demand returns commensurate with risk, and they're far more sensitive to market conditions than central banks pursuing geopolitical objectives. This shift creates what economists call a stability paradox. As private investors absorb more Treasury debt, they provide market liquidity and price discovery. But they also introduce volatility and the possibility of rapid capital flight during periods of stress. The Treasury market, which has historically been the world's most stable and liquid bond market, is becoming subject to the same dynamics that affect corporate debt markets. The interest burden on this transformed debt structure has reached levels that fundamentally alter the mathematics of federal finance. Net interest payments exceeded $1 trillion for the first time in fiscal year 2025. The Congressional Budget Office projects that net interest as a share of federal outlays will reach 13.85% in fiscal 2026, 14.11% in fiscal 2027, and 14.52% in fiscal 2028. These aren't abstract percentages. They represent a fundamental reallocation of federal resources from productive activities to debt service. Interest costs are projected to rise from $4 trillion over the last decade to $14 trillion over the next 10 years. That additional $10 trillion in interest payments represents resources that cannot be used for infrastructure, education, defense, or any other government priority. The average interest rate on total marketable debt has risen to 3.382%, compared to 1.583% 5 years ago. This means the government is paying more than double the interest rate it was paying in 2020, and debt levels are nearly 40% higher. The combination of higher rates and higher principal creates a compounding effect that accelerates faster than economic growth can sustain. But the most significant transformation is happening in the debt ceiling mechanism itself. What was designed as a constraint on borrowing has evolved into a managed expansion system. Since 1960, Congress has acted 78 separate times to raise, extend, or revise the debt limit. The Fiscal Responsibility Act of 2023 suspended the debt limit until January 1, 2025, allowing unlimited borrowing during that period. When the limit was reinstated at $36.1 trillion on January 2, 2025, it was set at a level that accommodated all debt issued during the suspension. The Treasury's use of extraordinary measures provides additional borrowing capacity of approximately $350 billion, allowing continued operations until Congress acts again. This creates a cycle where debt ceiling increases become routine administrative actions rather than meaningful fiscal constraints. The emergence of what bond market veterans call vigilante activity represents the market's response to this structural transformation. Bond vigilantes are investors who force policy changes by demanding higher returns when they perceive increased fiscal risk. Recent Treasury auctions have shown signs of weakening demand, with a $16 billion sale in May seeing disappointing results that contributed to broader market volatility. The 30-year Treasury yield climbed above 5% for the first time since 2007. Bond traders who had been quietly accumulating positions suddenly found themselves staring at margin calls they hadn't anticipated. The $16 billion Treasury auction that failed to attract sufficient demand wasn't just another weak sale. It was the moment when 4 decades of assumptions about American debt sustainability collided with mathematical reality. This discussion is for educational and analytical purposes only and does not constitute financial advice. While economists debated inflation targets and politicians argued over spending priorities, something more fundamental was occurring in the deepest layers of the financial system. The bond vigilantes, dormant since the 1990s, were awakening. These aren't protesters or activists. They're the algorithmic trading systems and institutional investors who determine the actual cost of government borrowing, regardless of what the Federal Reserve sets as its target rate. Ed Yardeni coined the term bond vigilantes in the 1980s to describe investors who force policy changes by demanding higher returns when they perceive increased fiscal risk. From October 1993 to November 1994, these market forces drove the 10-year Treasury yield from 5.19% to 8.05%. The Clinton administration abandoned plans for middle-class tax cuts and pivoted to deficit reduction. Market confidence returned, and yields fell to 4.16% by October 1998. The mathematical precision of this market discipline reveals why the current debt trajectory represents more than a policy choice. It's a structural constraint that operates independently of political preferences. When the government takes actions that increase inflation risk, debt levels, or default probability, bond investors respond by demanding higher compensation. This mechanism functions as an automatic stabilizer that can override legislative decisions through pure financial pressure. Recent auction results suggest this discipline is returning. Treasury sales have shown weakening demand patterns that correlate with broader market volatility. The 30-year yield breakthrough above 5% represents more than a technical level. It signals that private investors are beginning to price in the structural changes embedded within the debt expansion trajectory. The transformation of debt ownership amplifies this disciplinary mechanism. Foreign central banks, which provided a stable demand base for Treasury securities during the 2000s and 2010s, have not increased their purchases proportionally to the debt expansion. Private investors, particularly hedge funds based in jurisdictions like the Cayman Islands, have absorbed much of the incremental supply. These entities operate under profit maximization incentives rather than geopolitical considerations. Hedge fund involvement in the Treasury market has doubled over the past 4 years. This shift introduces volatility patterns that were absent when foreign central banks dominated the buyer base. Hedge funds utilize leverage and algorithmic trading strategies that can amplify price movements during periods of stress. The Treasury market, historically characterized by stability and predictable liquidity, increasingly exhibits the volatility patterns associated with corporate debt markets. The interest rate environment compounds these ownership dynamics. The average interest rate on total marketable debt has risen from 1.583% 5 years ago to 3.382% currently. This represents more than a doubling of borrowing costs at a time when debt levels have expanded by nearly 40%. The mathematical interaction between higher rates and higher principal creates a compounding effect that accelerates faster than economic growth. Net interest payments exceeded $1 trillion for fiscal year 2025, establishing what the Congressional Budget Office describes as the new norm. Projections indicate that interest costs will consume 13.85% of federal outlays in fiscal 2026, rising to 14.52% by fiscal 2028. These percentages translate to approximately $14 trillion in interest payments over the next decade, compared to $4 trillion over the previous decade. The resource reallocation implications extend beyond accounting entries. Interest payments represent federal revenue that cannot fund infrastructure, education, defense, or social programs. As the interest share of federal outlays approaches 15%, discretionary spending faces increasing compression. This creates a fiscal crowding out effect where debt service obligations limit the government's capacity to respond to future challenges or invest in productive activities. The debt ceiling mechanism reveals how constraints designed to limit borrowing have evolved into managed expansion systems. The Fiscal Responsibility Act of 2023 suspended the debt limit until January 2025, allowing unlimited borrowing during that period. When reinstated at $36.1 trillion, the limit was set to accommodate all debt issued during suspension. Treasury extraordinary measures provide an additional $350 billion in borrowing capacity, creating a buffer that typically lasts several months. This process transforms the debt ceiling from a binding constraint into an administrative procedure. Congressional action to raise the limit becomes routine rather than exceptional. Since 1960, Congress has modified the debt ceiling 78 times across both Republican and Democratic administrations. The mechanism preserves the appearance of fiscal oversight while accommodating whatever borrowing levels prove necessary for government operations. The extraordinary measures themselves illustrate the system's capacity for creative financing. Treasury can pause investments in federal employee retirement funds, suspend state and local government deposits, and utilize other accounting techniques to extend borrowing authority. These measures typically provide several months of additional capacity, allowing continued operations while Congress debates the next increase. Historical analysis suggests that debt ceiling confrontations follow predictable patterns. Initial political positioning gives way to last-minute negotiations that ultimately accommodate the Treasury's financing requirements. Rising debt levels might be viewed as temporary measures that will be addressed through future growth or policy adjustments. During periods of concern, the same debt levels might be interpreted as evidence of structural fiscal imbalance that requires immediate correction. The media and political discourse around debt issues influence these narrative frameworks. Technical discussions of debt to GDP ratios and interest coverage metrics compete with more accessible narratives about fiscal responsibility and intergenerational equity. Market responses often reflect which narrative framework dominates, rather than purely analytical assessments of financial metrics. Behavioral finance research suggests that institutional investors, despite sophisticated analytical capabilities, remain subject to herding effects and momentum trading patterns. During periods of Treasury market stress, these behavioral dynamics can amplify volatility and create self-reinforcing cycles of selling pressure or buying demand. The mathematical certainty of compound interest interacts with the uncertainty of political and economic developments to create what economists describe as path dependency. Once debt levels and interest costs reach certain thresholds, the range of available policy options narrows significantly. This occurs regardless of political preferences or theoretical economic models. Current projections indicate that interest costs will continue accelerating even under optimistic economic growth scenarios. The Congressional Budget Office's baseline assumes no major recessions, continued economic expansion, and gradual normalization of interest rates. Under these favorable assumptions, debt as a share of GDP still rises to unsustainable levels over the projection period. Alternative scenarios that incorporate more realistic assumptions about economic cycles, geopolitical developments, or demographic changes produce even more challenging fiscal trajectories. The interaction between an aging population, rising healthcare costs, and increasing defense requirements creates spending pressures that operate independently of debt service obligations. The structural transformation of American debt represents a phased transition from manageable obligation to mathematical constraint. Unlike gradual policy adjustments or cyclical economic changes, this transformation alters the fundamental relationship between fiscal policy and economic outcomes. The debt has become large enough and the interest burden heavy enough that debt dynamics begin to drive policy decisions rather than reflecting them. Physical laws impose limits on economic systems just as they constrain engineering projects. The mathematics of compound interest, the behavioral patterns of bond markets, and the resource constraints of fiscal policy operate according to principles that remain constant regardless of political preferences or theoretical frameworks. These forces are already reshaping government finance in ways that will become increasingly apparent as the debt trajectory continues its structural evolution. The machinery of fiscal constraint operates independently of political theater. Rising debt levels might be viewed as temporary measures that will be addressed through future growth or policy adjustments. During periods of concern, the same debt levels might be interpreted as evidence of structural fiscal imbalance that requires immediate correction. The media and political discourse around debt issues influence these narrative frameworks. Technical discussions of debt to GDP ratios and interest coverage metrics compete with more accessible narratives about fiscal responsibility and intergenerational equity. Market responses often reflect which narrative framework dominates, rather than purely analytical assessments of financial metrics. Behavioral finance research suggests that institutional investors, despite sophisticated analytical capabilities, remain subject to herding effects and momentum trading patterns. During periods of Treasury market stress, these behavioral dynamics can amplify volatility and create self-reinforcing cycles of selling pressure or buying demand. The mathematical certainty of compound interest interacts with the uncertainty of political and economic developments to create what economists describe as path dependency. Once debt levels and interest costs reach certain thresholds, the range of available policy options narrows significantly. This occurs regardless of political preferences or theoretical economic models. Current projections indicate that interest costs will continue accelerating even under optimistic economic growth scenarios. The Congressional Budget Office's baseline assumes no major recessions, continued economic expansion, and gradual normalization of interest rates. Under these favorable assumptions, debt as a share of GDP still rises to unsustainable levels over the projection period. Alternative scenarios that incorporate more realistic assumptions about economic cycles, geopolitical developments, or demographic changes produce even more challenging fiscal trajectories. The interaction between an aging population, rising healthcare costs, and increasing defense requirements creates spending pressures that operate independently of debt service obligations. The structural transformation of American debt represents a phased transition from manageable obligation to mathematical constraint. Unlike gradual policy adjustments or cyclical economic changes, this transformation alters the fundamental relationship between fiscal policy and economic outcomes. The debt has become large enough, and the interest burden heavy enough, that debt dynamics begin to drive policy decisions rather than reflecting them. Physical laws impose limits on economic systems just as they constrain engineering projects. The mathematics of compound interest, the behavioral patterns of bond markets, and the resource constraints of fiscal policy operate according to principles that remain constant regardless of political preferences or theoretical frameworks. These forces are already reshaping government finance in ways that will become increasingly apparent as the debt trajectory continues its structural evolution. The machinery of fiscal constraint operates independently of political theater. While legislators debate spending priorities and economists model theoretical scenarios, the mathematical relationships embedded within the debt structure continue their relentless progression. The $38 trillion threshold represents more than an accounting milestone. It marks the point where debt dynamics begin to override policy preferences, where compound interest becomes a more powerful force than legislative intent. The transformation is already visible in the data. Interest payments have crossed $1 trillion annually and show no signs of deceleration. The Congressional Budget Office projects that debt service will consume nearly 15% of federal outlays within 3 years. These aren't projections subject to political revision. They're mathematical certainties built into existing obligations and current interest rate structures. The shift in debt ownership from foreign central banks to profit-driven hedge funds has fundamentally altered the stability characteristics of Treasury markets. Bond vigilantes, dormant for decades, are awakening to impose market discipline on fiscal policy. Recent auction results suggest that the era of unlimited borrowing at artificially low rates is concluding. The debt ceiling mechanism designed as a constraint has evolved into a routine expansion tool that accommodates whatever borrowing levels prove necessary. This structural evolution suggests that the relationship between government policy and market forces has inverted. Rather than markets responding to policy decisions, fiscal policy increasingly responds to market constraints. The mathematical precision of compound interest, the behavioral patterns of institutional investors, and the resource limitations of government finance operate according to physical laws that remain constant regardless of political preferences. The system is adapting to these constraints in ways that are already reshaping government operations, even as public discourse continues to frame debt as a policy choice rather than a structural reality that imposes its own logic on everything else.